Welcome to this Killik Explains finance video. This week, Carillion's collapse, 6 investing lessons. There are loads of investing lessons, but here are my top 6. So what happened? Now, frankly, you'd have to be living in some sort of paper bag not to know what happened, but Carillion was the UK's second largest construction and facilities management company. It's now in liquidation with 43,000 employees. It was involved in some massive headline projects, the redevelopment of Battersea Power Station, Anfield Football Stadium, and on top of that, it was responsible for 50,000 Ministry of Defence houses, around 900 schools, highways, prisons, the list goes on. So it had fingers heavily into the public sector as well as the private sector, vast range of involvement across a range of different contracts and projects. What went wrong? Well, just to summarise, it's now in liquidation, early 2018. But in 2016, sales looked okay, 4.5 billion, market capitalisation of around 1 billion, but under the bonnet, debts of 1 billion and a pension deficit of around 0.6 billion, a problem that not only Carillion faces, by the way. Cost overruns on key projects became very apparent and basically sunk it, and the share price started collapsing in July 2017 following no less than 3 profit warnings in the space of 5 months. There's a potted summary of what went wrong. Now, that's happened. So the key question is, although anyone can be wise after the event and look smug and say, well, I didn't buy the shares and here's why, actually there were red flags. So what I'm saying here is, yeah, by all means, stay with a company like this if you really want to as an investor, but do be aware of the colossal amount of risk sitting under the bonnet. Now, how do you know that? Well, multiple acquisitions, first of all. Am I saying never look at a company that buys other companies? Clearly not, because that would strip out half the market. But when you take a look under the bonnet here, a string of big deals. Molim in 2006, Alfred McAlpine, John Lang Facilities, these are big, boisterous acquisitions. And almost by 2016, the company had bitten off more than it could chew. An attempted merger with Balfour Beatty, another giant, failed. I think Balfour Beatty got sort of cold feet, if you like. And that alone was a warning signal to quite a few analysts and investors. Now, why do directors do this? Well, acquisitions are a quick way to grow a business. Faster, arguably, and easier, arguably, than doing it organically of your own profits and cash flows. It's evidenced animal spirits and ambition. Okay? Debt has been cheap for a decade, so the funding of these things is relatively cheap, and the accounting can flatter profits in the short term. There is an accounting benefit to doing acquisitions, which I cover in another video and will mention right at the end. Now, the problem, big acquisitions, is we've got to watch as an investor. This is all very well, but they take up a lot of time and effort. Directors are often better at buying than integrating. In other words, they look for the next target, take their eye off the ball when it comes to actually integrating past acquisitions into the fold. And synergies, that word that's used all the time to justify acquisitions, cost savings, efficiencies and so on, often take years to be realised, if indeed they are realised at all. Now, when you look at the list, by the end, just before it collapsed, Carillion's sector spread was, well, on one view impressive, on another one ridiculous. Aviation, education, healthcare, finances, oil and gas, retail, leisure, defence, in the UK and in other countries, in other domains, if you like, public sector and private sector, it was quite a mess, essentially. Very challenging for any board of directors to make anything coherent out of such a broad diversification across sectors and geographies. Number 2, it's not all about the acquisition strategy, high dividends. Now, at Carillion, the 2017 share price peak, we had a dividend yield of 7.7%. Red flag, all right? And its projected yield was a meaty 8.1%. Well over double the equivalent available on the FTSE All-Share, if you like, and supposed to be backed by solid cash flow. That was the claim made around the time by the board of directors, not in fact the case, really. Investors appear to have been lulled in by a seemingly free lunch. In other words, this was a dividend trap, and investors needed to see it as such. The firm's cash flows are actually very complex and dependent for realising them on long-term contracts. Long-term contracts, always, you need to look under the bonnet very carefully. And if you don't understand what's going on, don't invest in the company. And the firm's operating margins were thin and under a lot of pressure. More about that coming up in just a moment. So there was a red flag in terms of a dividend yield that was simply too good to be true. But that's not all. What about those vulnerable margins? Now you might say they weren't that vulnerable. They had sales of 4.5 billion in 2016, so they're doing well enough there. Key divisions, some divisions were reporting rising revenues almost until the end, if you like. Operating profit, 146 million, and compared to peer group, not bad. An operating profit margin, 3.3%. But the point is, this is a peer group where operating profit margins are squeezed down to the bare minimum. There's no wiggle room. There's no margin of safety. Making money from the public sector used to be like shooting fish in a barrel, if you like. That's not the case anymore. So Terry Smith would say, what about the gross margin further up the profit and loss account? Sub 10%, very little margin of safety, danger, unless you're an investor who knows exactly what they're getting into. The operating profit margin, although there was one, and it was higher than peer group in some ways, if you like, on some readings, was being absorbed by interest payments, pension payments, that annual dividend I mentioned, got to maintain that potentially, and operating profits and margins overall were falling. What's more, the firm was spreading into areas where it was earning a slightly better margin, but not receiving cash. Middle East, a case in point, around 400 million was never received from contracts out there. Then there's working capital stress. Now, I cover this in more detail, video link coming up at the end. So what do I mean by that? Carillion operates a lot of long-term contracts, all right, in order to deliver these big long-term projects, and quite a few companies do that. The problem is this, and the fact that the accountants are sniffing around this area and about to release a big new accounting standard, too late for Carillion, should send up a warning signal in its own right. Problem with these long-term contracts is that profit and cash flow often don't come at anything like the same times, all right? And that means you've got a complex supply chain, you need skilled stock and supplier management to bring these contracts home, and you've got to keep a whole eye on the cash flow situation. So, signs of trouble, right? So how could you spot there was trouble here, if you like? Lots of ways. Suppliers were waiting 120 days or more for payment by Carillion, and yet this is a company where one of its primary customers is the government, who pay actually reasonably regularly and kind of on time, 30-day standard payment terms. So there's a red flag. How come they have to squeeze their suppliers so much? Number two, it relied on something which is commonly used for those companies in this kind of sector, an early payment facility. But as an analyst, as an investor, you've got to look at where the debt was, I wouldn't say being hidden, but where the debt, so converting supplier balances into bank loans, where that was sitting. Did you have the full picture? Could you see how much they truly owed, if you like? Receivables were rising faster than sales. That's always a red flag, potentially. And annual cash flows were relatively volatile for a business that, in theory, was reasonably steady, underpinned by these big government-backed contracts. Short selling interest. Now, lots of other people, who are not just Tim Bennett, spotted the problem. So, as an investor, short selling interest matters, even if you don't fully understand what these people are doing. Essentially, these are not very popular sometimes, but these are hedge funds, investors basically taking a lot of risk. They take a lot of risk, they borrow shares they don't own, they use derivatives if they're available, and there weren't that many derivatives available actually as it happens on Carillion, CFDs and so on, but if they can, they deploy leverage, which means risk, to bet on falling share prices, to bet on trouble. That makes them a little bit unpopular, but because they're taking a lot of risk, they need to know what they're doing, if you like. So these tend to be pretty sharp investors. Now, Carillion was a popular short-selling target from way back, from months ago, basically. At the start of 2017, around a quarter of the stock was being shorted, and that peaked at 32%. Now, short sellers can get it wrong, and when they do, it's incredibly expensive for them. But you should take note of it. If a company is in the top 5 short interest stocks, and you can pick up this information, by the way, at several websites, there's one down there, be careful. Finally, poor technicals, if you like. So this is kind of the smell test. So strong stocks are supported by solid and ideally rising financial strength. And you can get snapshots on financial strength. There's a thing called the Piotrowski Z-score, which gives you a snapshot, but otherwise you can do the homework yourself if you like. They have share price momentum and positive relative strength indicator, RSIs as they're known. All right, they tend to maintain or improve their position in their peer group over time. Whereas at Carillion, you've got deteriorating operating financial strength and profitability, downward share price momentum towards the end, and a hugely negative RSI. Got a video on that one too if you're interested. And consensus earnings forecasts were being revised down, and analysts were increasingly having to strip out one-offs, profits that were kind of propping up the view of the company's fortunes. So the smell test wasn't good. The technicals test, as I call it. Now the main takeaway is what then? No single stock is ever safe or too big to fail. And people say, well, you know, their main customer was the government. That's no safeguard anymore. So line of business, main customer size, diversity, geographic spread. In fact, these can be much of a headache as they are a kind of safety net, if you like. As an investor, you need to diversify a portfolio. You don't necessarily want a board of directors running one company to spread themselves too thin away from what is their core competence. Other related videos, so I did mention a few videos covering topics I've been through during this one. So if you'd like to know more about investing red flags, because I've just highlighted a few fairly fast here, do go to the Investing Red Flags tab within killik.com/learn, and there are some titles you might be interested in. Hit the Shares tab within killik.com/learn, and you'll get videos on things like the RSI, there it is, earning manipulation, and so on. So if you found this a little bit short and punchy, there's some more detail in those videos. Any questions? editor@killik.com, and once again, that address for those related videos, killik.com/learn.